Good afternoon. Um, Thank you very much for joining us. We do have a number of attendees on today's topics, which actually is very, very nice to see. So I don't know if it's because we're holding this presentation or this webinar at lunchtime. So if that is the case, if this time suits you, please give us as much feedback at the end of the presentation. It would be much appreciated. So I think we'll kick off, and anybody who joins us later on can just come on in. So thank you for coming on today and giving us your lunchtime dedicated to try and get a better understanding of savings and investments. There seems to be a great turnout for this particular topic. So it's obviously something that's of interest to most people. The reason we decided to host this about investments and savings today is because of the large interest and the demand that we've had for these products. It seems now more than ever before, people want to make sure that they're acting in the best way possible to grow their wealth. So there's basically two ways in this world to make your money work for you. One is to work and earn it, and the other is to have your money invested so that it earns for you. So hopefully today you'll help identify the hows and whys, and you'll get a bit of direction in relation to what actions you can take to make the most of what you've already got. So for those of you who don't know much about Oaktree, this is basically who we are. So the business commenced in 2010. We do have over 1,500 clients and over 20 million in assets under management. We are a small bespoke company, and we do pride ourselves on giving the highest level of customer care. That's really what it's all about for us. So we have held a number of these webinars since the start of the pandemic to try and address specific topics that are of particular interest to people. We're always looking to cover new topics. So if there's anything of particular interest that you would like us to cover, please do let us know, because we're always open to suggestions. And if there is enough interest, we'd hold a webinar on that specific topic. And if not, we'd happily liaise with you directly on a one-to-one basis. So I'm not doing the talking today. Adrian is going to do it because he's so much better than me. So just a little bit of housekeeping before I hand you over to Adrian. So today the presentation will last approximately 30 minutes. The information that Adrian's going to cover with you, it is very generic, but at the end you'll have the opportunity to pose any questions that you have. If you communicate, there is a question and answers box. I know the screen that I'm looking at, it's at the end. So, but in some cases, depending on the setup, it might be on either side of your screens. So please pop your questions in there, and at the end, we'll cover and answer as many of those as possible. So Adrian, over to you.
Thanks, Tracy. When Tracy says that I'm presenting today because I'm a better presenter, it actually means I lost the toss, and so I'm the one who has to give the presentation today. Thanks a million, Tracy.
I'll cover off, no problem.
Hello to everyone, and thanks a million for joining us on the webinar this afternoon. As Tracy said, what we're looking here at is savings and investments. It is very kind of generic presentation. What we want to kind of do is just cover off some of the various bits and pieces. So kind of a general overview of savings and investments. Everyone is kind of talking about 60-40 investment portfolios, what really those are. A look at risk profiling, fund selection, and investment charges, which all kind of form part of the actual investment process. A look at the review and rebalancing and exiting from the actual investment then at a later stage. And then we'll have time at the end for some questions and answers. So just to go through investing itself. So I suppose everyone has this view that investing is stock exchange investing, that you're buying and selling shares, you're in Wall Street, and it's not actually that at all. Investing can be something very, very small and very, very simple to deal with. It's the main key to it is actually building wealth, and it's developing good habits. So, you know, even from a very early age, if you have been saving in a piggy bank and things like that, it's just developing out that and actually just using investing as a different form of saving if you want. So, as we've mentioned, the developing the good habits is regularly putting money away. So saving money and investing it are very closely connected. As I've said, you know, what you need to do is save first in order to be able to invest, because that's really what how you can gather together your money, unless it comes from inheritances or something like that. Um, Savings plans with life insurance companies and most banks are in fact not a typical savings product, but a form of investing. So again, just remember that as we're talking through today's presentation. Savings plans in general are really more to do with kind of bank deposits and things like that. So just a little bit of a kind of an overview of the differences between the two. So savings is a stage on the way to investing. You cannot be an investor without being a saver, but you can be a saver without being an investor. So, sorry, I think I said that wrong. You cannot be an investor without being a saver, but you can be a saver without being an investor. So when you're actually doing this, if you are looking at savings plans and things like that, so you know you're a couple of euros every month going into the credit union or into the bank, that's a saver. You don't need to invest that any further. You can actually leave it sit with the institution that you've left with, and therefore you remain being a saver. But to be an investor, you obviously have to have saved in the first place to actually be, in order to have those lump sums. So again, when someone talks about savings and saving money, it primarily refers to you know, the piggy bank on the mantelpiece, or a high interest deposit account, as is what I've written in here. But as we all know, those are few and far between. If you can actually find one, let me know, please. They are, I suppose, deposit accounts now, depending on the amount of money you have in them, they're now actually returning a negative interest rate. But in most cases, it's something like maybe 0% or 0.01%. I know with credit unions, in a lot of situations, there has been no dividends or loan interest rebates in the last number of years. And if there has, it's been at a very, very low level. So savings are effectively cash or cash instruments, such as deposit accounts or term bonds. That's basically what we're looking at with the savings side of things. Investing is what you can do with the savings that you have created. So if you're looking to generate a return on your money that is greater than what is already available to you through your savings instruments. So again, if you're looking for a return greater than the 0.01% that you're getting from the bank, then you're into the territory of looking at investments and investing. So typically, as a saver, you will be taking very few and very small risks with your money. It is left with that institution, like AIB, Bank of Ireland, Credit Union, and so it really isn't. While it's not doing a lot for you, it's also not at risk or at very low risk. As an investor, you will be taking a much greater risk. So anything obviously above being in a bank account means you are now in a risk territory. Not only is it the return on the on offer is likely not to be fixed or guaranteed, but also the capital sum you invest is typically at risk as well. There are some products out there that have protections, or the old word would have been guarantees, but their protections are like 100% protected or something like that from some of the products. But the returns from those products are going to typically be lower. So again, it is still investing. Some of them do have conditional capital protections built into them. So just be aware of what the product is that you're looking at, where it says guaranteed, not protected. So why would you want to take any risk with the money? Of course, the main thing here is that you're going to be looking at the potential rewards. So you may need to generate an income from that money, and you obviously want that income to be greater than what you're getting from the bank, the building society, or the credit unions. And that's really it. That's why you would look to invest in the first place, is because you want to actually get the potential rewards from a greater return. So just looking at some of the pros and cons here. So saving, the pros of saving. So the euro amount in your accounts won't decrease. So again, if it's sitting in the bank or the credit union, it's not going to decrease. The con of that is that you could lose purchasing power due to inflation. As inflation increases, the buying power of your euro decreases. One of the other pros, you can safely reach your goal on a set timeline if you save the proper amount. So again, you might be saving towards a deposit for a house or a car or something like that, and you literally take that amount of money that you're looking at, divide it over the period of time that you want to save, and then you save that amount. But you may have to save more in that situation to reach the same goal versus earning higher returns with investments. So because there is little to no return on that saving, you really have to kind of save every penny of it. On the investing side, there are potentially higher returns than saving. Now, again, obviously the con of that is that investments could decrease in value. So it is something that there is a bit of a trade-off there, that you have to be willing to accept that in order to seek those higher returns, there is a potential that your investments could decrease in value. Again, one of the other pros is, due to the higher returns, you may not have to contribute as much money to reach your goals. So again, if you're saving for that deposit, and let's say it's 20,000 or something, although you won't get much for a deposit of 20,000, but take that 20,000 under a savings plan, you know, with a bank or a credit union, you're going to have to save all of that 20,000. If you're investing your money, then the hope would be that in order to reach that 20,000, you're using the money you've put in as well as the returns that you're getting on that money to reach that goal as fast as possible. Again, though, one of the cons is you may have to delay a goal if your investments decrease in value right before you reach your goal. So again, you're looking at that 20,000, markets may dip, and so there could be a reduction in the return that is coming back on your investment, and that may impact the timing of you actually withdrawing your cash and using it for your specified goal. One thing to remember here is on the exit process, and we cover it off later on, it's all very, it's very important to kind of discuss with your institution, wherever it may be, whether it's with a broker or through a company directly. Talk to them and advise them in plenty of time before you're looking to use that money of your intentions. So 12 to 18 months out, that you're coming back to us and telling us what it is you actually want to do with it. That gives us time to try and get you out at the highest possible points over that period of time. The 60-40 rule, so I guess it's a generations old investment rule, and has been by some classed as the no-brainer portfolio. I suppose it's been widely recommended by a number of celebrity brokers, I suppose we call them, over the last number of years. But you really need to know what it is actually about. And realistically, what it is, it's very simple. It's 60% in stocks and 40% in bonds. And it's designed to expose your portfolio to the potential gains you'd get from stock ownership, but with a certain amount of safety by way of holding bonds. Now, traditionally, this would have been where you would have been looking at bonds that were returning an income on a regular basis. Unfortunately, that's not the situation now. So in the past, you'd have had a situation where your 60% in stocks was rising through growth, through dividend reinvestment, various things like that. But also the 40% in bonds was also getting a return as well. Where it's at the moment is the bonds are static, and the income from the stocks is basically what's trying to produce all of the income at this stage. So again, while it may still be a decent strategy for diversifying your assets, it may not go far enough. one of the biggest things is that, going right back maybe to the 90s when the dot-com bubble would have started, the bonds started to lose not their value, but their income earning potential. And right the way through from the 90s onwards, they haven't really recovered that. So it is important to remember that if you are using a 60-40 strategy, it may not suit or may not go far enough for what it is you actually are looking for it to do. So investing today, slightly different. What we look at today, we look at a number of things in terms of a fund allocation. We look at your risk tolerance, we look at the time horizons, and we look at the financial goals. So just to cover off the risk tolerance, or risk profiling is really what we're talking about here. It's a process for finding the optimal level of investment risk by balancing your risk required, risk capacity, and your individual risk tolerance. So it's a combination of all three, and that identifies your actual risk profile. So just to go through each one. So the risk required is the risk associated with the return required to achieve your goals from the financial resources available. So what's the return you're actually looking for here? The capacity is the level of financial risk you can afford to take, and the tolerance is the level of financial risk you're emotionally comfortable with. And that's very important, because you do need to remember that we are all emotionally connected to our money, even though we think we aren't. If you suddenly get told that your money has halved in value, you will be emotionally compromised by a statement like that. So there's often a mismatch between the risk required, the capacity, and the tolerance. And our job is to identify those mismatches and resolve them. So it's to bring it all together and actually make sure that you're clearly identifying what your profile actually is. So you could have someone who says they're not concerned with, or they're quite willing to take a huge what's the word, a huge difference in between what their minimum return would be and their maximum return would be, or the loss that they would be comfortable with, but yet at the same time would be quite uncomfortable with a 6-month short downturn in the economy. So it is very important to make sure that we actually can view all of this and actually come back with what it is you're looking at. The risk rating. So I just to explain, when we go and do the risk profiling with a client, we get clients to answer a number of questions. That then is taken into our system, and we actually will be able to generate what those answers from a set of questions, what they will actually generate in terms of a risk profile. The profiles then themselves range from 1 to 7. So I'm not going to go through these, but I suppose I have a very simplified way of explaining these. 1 is you're sleeping on it, and 7, we're all in Vegas putting it on black. It's a very kind of crude way of describing it, but realistically, that's kind of what you're looking at. So 1 is very low risk, 2 is low risk, 3 low to medium, and so on, that you come up as far as 4 medium risk, 5 is medium to high. Sorry about that. 6 is high risk, and 7 then becomes very high risk. So most people, you will find when they actually do a risk assessment, and again, it will depend on the time frame, but most people will come in at a 3, 4, or 5. So somewhere between a kind of a low to medium, right the way to a medium to high. There's very few clients that will actually come in at high risk, and certainly none in a number of years that I have been in the industry that have come in at very high risk, which is this risk rating of 7. So it is important for people, when they're doing this, to make sure that they've answered those questions correctly. Not correctly, but in their own thoughts. If you have someone who spends kind of maybe too much time looking at the question, they're trying to answer it in such a way to fit a certain box that they think we want them to fit, that we as advisors want them to fit. At the end of the day, for us, it's hugely important that people answer those questions truthfully, because we need to make sure that whatever risk rating a client comes back with is what's actually used for them. because that all leads to what kind of funds and everything like that we actually deal with. So the time horizons and goals will also form part of this this process in terms of looking at the risk profiling as well. And I probably should really have had the time horizons and goals back a little bit, a couple of slides back before bringing up the 1 to 7. It's important when you're looking at it that at an investment time horizon that you understand what it is your goal is. So an investment time horizon is the time period where one expects to hold an investment for a specific goal. So whether that goal is, as I said, is saving for a mortgage or a deposit for a house, or an investment, or not an investment, but a wedding, or which is an investment, I suppose, a wedding or a car or whatever it actually is, or maybe it's your children's education. There's always something that we all are aiming for. So it's important to understand what that time horizon is. So for example, if it was a children's education, so well, your child is maybe 3 or 4, they're not going to college until they're 18, then you're looking at a 15-year time horizon there. Short-term horizon refers to investments that are expected to last for fewer than 5 years. These investments are appropriate for investors who are approaching retirement or who may need a large sum of cash in the near future. So in those situations, that short-term horizon is going to impact what they can actually invest in. In most cases, we would be suggesting for those clients that that monies should be really held in cash and should not be invested any further. Medium-term investments are those which one expects to hold for 3 to 10 years. And again, this is college funds, weddings, or your first home. Those, yes, you can invest, right? Because what you're looking at is a longer time horizon, and that will help in terms of your investment portfolio. The last one then is the longer term investment horizon is for investments that are for greater than 10 or 20 years or even longer. Most typically, these are going to be your pensions, your retirement savings. Typically, when you look at these, the long-term investors are willing to take greater risks in exchange for greater rewards. Okay. So if we look now at fund selections, just to give you a kind of an overview of the various different types of funds that are there and where they would sit. So cash would have a risk profile of low. Fixed income would have a risk profile of relatively low. Property would be medium. I'm not so sure I'd class property as medium. I might actually class it as a little bit higher risk, just depending on the length of time that the client is actually willing to look at this. Equities are medium to high risk, and alternative investments. So these are investments that don't fall into the main classes. So they'd be commodities, oil, coffee, gold, foreign currencies, those kind of things. Possibly Bitcoin would fall into the alternative investments. A risk profile of high, I would say Bitcoin would be probably a very high risk, given its volatility. I saw a hand raised there, but if it's okay, we might actually just deal with the questions at the end, if that's okay. Okay. Sorry, that is that. So just to give a quick view on investment charges and things like that. So this, I suppose, is something that a lot of people would have a lot of concern about is, well, what exactly am I being charged for? What is the way that the investment charges work for me? So these are 3 of them. There's more. So the allocation rate, so the percentage of your investment that is used to buy units in a fund. So a 98% allocation rate means that for every 100 euros you invest, the investment company invests 98 and takes 2 euro as a charge. So that's the first one, is the allocation rate. You'll often see this quite specifically in relation to pensions, where you might have a 95% allocation rate through a specific type of pension. That means that 95% of your money, or 95 euros out of every 100, is being invested, and the other 5 is taken as a charge. And that's typically taken by the investment companies. The bid offer spread, again, that's the difference between the price to buy and sell units in a fund. If the difference is 5%, it means €5 out of every 100 used to buy units is taken off of the charge. Just on the bid offer, we actually would have very few funds that would actually have a bid offer spread on them. So it's not really something that we deal with. On the allocation rate, just to explain as well, again, typically on our funds or anything that we use for our clients, we would ensure 100% allocation rate because we believe it's important that there is 100% of the monies invested. Just on the allocation rate, again, I'm just going to say one more thing. There is, if you're going into an investment, there is a 1% government levy, which unfortunately is outside of our control and outside of the control of the investment company. It's taken straight off the top by the government. So that's a 1% government levy will apply. And then everything after that will be subject to the 100% allocation rate. In most cases as well, there is a policy fee, a monthly policy fee, typically ranging from €3 to €6. It's not on all funds, it's on some. So just make sure that when you're talking to your advisor or talking to your bank or whoever it is actually going to do the investment for you, that you're aware of what those charges are and what way it will impact on your fund. Then we also have the product management fee. This is sometimes charged for ongoing advice from a financial advisor or a stockbroker, maybe between 0.25% to 1% of the value of your fund. That's on top of the yearly management fee. And again, that typically ranges. So the yearly management fee or the annual management charge is charged by the investment company. So whether that's Aviva, Standard Life, Zurich, whichever company you're actually investing with. And so the two of those are combined together to form your overall annual management charge for both the investment company you're dealing with and your financial advisor. One of the other things to remember is this early encashment charge. And this is, I suppose, where we take people, look, if you're looking to access your money in the next 5 years, then this is really maybe something you should look to save in a bank or keep separate, because there is typically an early encashment charge going from 1% to 5% or 5% to 1% if you want. So in year one, if you take out your money, it's subject to a 5% early encashment charge, which is quite considerable. Especially if the fund hasn't already kind of generated a 5% return for you. So it is important to just remember that those early encashment charges are there. Again, when we would be talking with clients, if someone is looking to withdraw their money in the next 5 years, we typically say to them, look, this is probably not going to suit you. Once you've invested your money, it's going to be hugely important that you actually review this and rebalance it. So let's say you've invested in a fund and it's a risk rating of 4. So you're willing to take a risk level of 4 in regards to your investment. Over the course of the year, the market value of the security within that fund, within that mix of funds, is going to change. So if we go back to the types of funds, if I just go back to this slide, when we're actually creating a fund selection or a fund portfolio for our client, if you're and just take these as being 1, 2, 3, 4, and 5 for argument's sake, if you are a risk rating of 4, it doesn't mean that 100% of your money is going to go into equities. There will be a mix. So you will have an overall blend of all of these combined to give you your risk rating, to give you your fund selection based on that risk rating. So it's important to remember that there's always going to be a mix of these in there. But if you then have a situation where the various components of that investment have generated a different return, well, then it's going to result in a weighting change. So the portfolio rebalancing, it's basically like a tune-up for the car. It allows individuals to keep their risk levels in check and minimize your overall risk on the fund. So it's the process of buying and selling portions of your portfolio in order to set the weight of each asset class back to its original state. So it's also important as well to look at it if you feel that your risk rating has changed. You may something may have changed, your time horizon may have changed, something like that. Then we would redo your risk profile and actually check to see, well, does your new risk profile match your current fund portfolio? And if not, then it will be rebalanced. So this just gives you an idea of a fund at the start where you've said, okay, I want 50% in bonds, 40% in equities, and 10% in a treasury fund. I know these are US dollar figures. It was more for the chart really that I was using this. But by the end of the year, if your bonds haven't performed as well as what your equities have, well, then what's going to happen is that your overall bond fund is now only 42% of your overall asset base. So you need to rebalance that. You need to go back to a stage of increasing the bonds by 8% and reducing your equities and increasing your treasury fund to rebalance that fund and make sure that it does exactly what it is supposed to do. A lot of people will look at this and say, well, but my equities have done really, really well. And therefore, because they've done really, really well in the past, should I not stay and just leave things as they are? Absolutely, you can choose to do that. But remember that past performance is not an indicator of future performance. And so you could end up in a situation on year 2 where you've had 49% exposed to equities, and that suddenly contracts considerably due to something happening in the economy. So again, it is very important to remember to review and rebalance your fund as you go throughout your investment process. So just in relation to encashing your funds, as I mentioned earlier, the timely exits is what we would call it. Always look at advising your broker or your consultant or whoever it is that your proposed exit is going to be 12 to 18 months from now. So my daughter is going to college in 12 months time or 18 months time. So I will need access to that money to get her to college at that time. We're not saying that you're going to exit it now, but it just means that from your advisor's perspective, what they can do is they can look at the market as it currently is, and they can start to de-risk your funds, de-risk your portfolio from an early stage, so that if something does happen in 6 months time or 12 months time, where the economy, where markets have had a serious downturn or something like that, that it's not impacting significantly on your final figure. So it is very much important that we're aware of your proposed exit date effectively, and it just allows a smoother exit overall. Know your tax. Again, this is going to be hugely important for a lot of people. Remember what the tax rate is that you're actually going to be paying on the gains that you make in this. Is it an exit tax, which unfortunately is in Ireland is ridiculously high at 41%. That's irrelevant of whether you have any other income or anything like that. It is just an exit tax. It's effectively a dirt rate on investments. For years, the industry has lobbied to actually try and reduce this. Unfortunately, hasn't happened, but we still keep lobbying. There are, depending on the types of funds that you're invested in, then some funds may be liable to capital gains tax. Sorry, just to go explain on the exit tax, that is deducted at source. So your life company, so for example, Zurich will actually take care of that 41%, and they will deal with it at source. Other funds that become liable to capital gains tax or income tax are subject to those taxes under the self-assessment system in Ireland, and so therefore you are responsible for actually making those filings. So it is important that you understand what tax is payable and become aware of when it's going to actually be payable. Again, as I mentioned earlier on, just in relation to encashing your funds, understand the implications of the early exit, the access, understand when you're going in what the early exit penalties are. There's no point in finding out 2 years into an investment when you need the money that really you shouldn't have gone into this, because you were only ever going to look for this for a 2-year time frame. Understand as well that if you have kind of gone into it with eyes wide open and that you were aware of the 5-year exit penalty clawback or exit penalty on the investment, that if you do need access to it, yes, the access is available to you, but will be subject to that exit penalty. Again, it's just hugely important just to remember that. That is a real, I suppose, whistle-stop tour of investments and savings. I'm hoping that it will have answered some people's questions and queries in relation to the whole thing. But if not, if anyone has any questions now, we can deal with them now. Tracy, are you back on, Tracy? Tracy, if you want to put down your mic.
There you go. Can you hear me now?
Yeah.
We have just a few questions have come in, which is probably good because I know we've gone slightly over the time. So you go into so much detail, Adrian.
It's called waffle, I think, Tracy. We did have this discussion earlier this morning where I was trying to do a short mass, as I said earlier on. But I never make a good priest.
Okay, so one of the questions is, can the savings be used for children? So I gather they're referring to children's savings plans.
Yeah, and again, what I mentioned on this is so we call them, and they're classed within the industry as children's savings plans or regular savings plans. They're not savings in the traditional sense, as I said, they are actually investing. So you are using the money in those situations to invest. There's kind of two products there really. One is that you would just do a general savings plan and just use those monies when the child turns 18. Or there are specific child savings ones where you basically are creating a trust for the child with those monies each year that you're contributing to the policy. A lot of people would use that for inheritance tax planning, making sure that they're passing their wealth on to their children from a very early age.
Okay, that's great. Thank you. The next question that came in was saying, can companies make investments? And if so, what would the tax implications be?
Yeah, they can. So they are, the tax implications on it are slightly different. So while there's a 41% exit tax, it's treated differently within a company, and it typically becomes the 25% corporation tax rate applicable to other income. Yeah, companies can do it. You know, there's nothing stopping corporate investments. One of the huge areas we would have seen, Tracy, in the last year has been corporate investments, where companies have been seeking higher returns and taking the money from their bank account or their bank deposit account and actually trying to secure a higher return with that money.
There's been a few more questions that have just come in now here as well. How do commissions affect allocations? Do you want to cover that one? I love you answering these questions. Great.
So in most situations, they wouldn't, right? So again, it depends. It depends on how the product is being set up. With our structures, we don't actually. There is no impact on the allocation rate. It's always about making sure that the client has gotten 100% allocation. So that's going to be our biggest thing. Yes, we do receive commissions. Obviously, we do. That's how the industry in Ireland works. And we're quite happy to disclose those. And under the current regulations, we have to disclose those. They're available on our website, and it explains in full detail how they all work. But typically, we would make sure that the allocation rate isn't impacted for our client.
There's actually a very good question here saying, do you envisage that the exit tax of 41% would decrease over the next 20 to 30 years?
Yeah, I'm just looking at now on here. I'm hoping it does, because 20 to 30 years is a long bloody time of lobbying. Look, we've been lobbying it for years. So look, you'd love if there was a reduction in it. I suppose the government are looking at this. They're probably making too much money off it at the moment. Markets have been so strong over the last number of years that a 41% exit tax is exactly what they need. Is there a situation in the future if markets collapsed again? Would they not be as, maybe they might be more lenient to reduce that tax? I don't know.
There's two more questions come in, so if we're quick, we might be able to cover them. What would the best asset split for long-term investment be for 10 to 15 year for high risk individual?
Okay, there's no kind of quick, easy answer to that. One of the things that you will have to look at there is the age profile of the individual as well, because age will have a factor on the risk assessment. I know they're coming in saying that they are a high risk individual. And one of the things I should have said is that it's very interesting. It's very interesting when people come to us and they say, I'm a high risk taker and I'm quite comfortable with very high risk or high risk investments. And when they answer the questions in relation to that risk profiling, they're actually anything but, they're much lower. I'm not avoiding the question, it's very, but I'm avoiding it. Best asset split, it's very hard to know. It's very hard to know. It would just depend on the individual themselves.
Yeah, I think under those kind of circumstances, yeah, age and risk profile is going to be a big part of it, and also targeted returns. You know, if you have a set target to achieve a growth level, that
Yeah.
really is going to help, you know, dictate the selection of the investment strategy, or the, you know, the weighting in which you would hold within your portfolio. So you might have
that one earlier.
Yeah, you might have a little bit more of the satellite funds participating on it. So yeah. Okay, is there any consultation fee to discuss options with Oaktree?
Typically, no. What we do is we do have a 1 hour free consultation, so we can discuss things with clients. If there is going to be consultation fees, that will be outlined at that point, and we can explain to them what we're actually what we're looking at. But typically, there is that 1 hour free consultation available to people.
And then the very last one that's here is, what is the 40% exit tax charged on?
41% exit tax is charged on the growth. So it's not charged. So if you put in 100,000 and it grows to 120,000, the 41% exit tax is charged on the 20, not on the overall 120, just on the gain. That's all it is.
And that's basically it then. So I think we've actually managed to cover all the questions. So there wasn't too many coming in.
Okay.
So thank you very much for all your time, guys. Yeah, I hope that was useful. Everyone. Thanks, Adrian.
Okay. I know it is being recorded, so I think Adrian will make it available to everyone. I think he'll be looking after that. So it will be available to view afterwards if anyone wants to listen back to it or listen back to me again. Thanks very much.
Thank you.
Thank you. Bye.
All the very best. Bye now. Bye-bye.